Hello, and thank you for tuning in. I truly love to work on content like this, to be a resource for our investors and then keep them informed about what's happening. But obviously, these moments are tougher ones because we're talking about the conflict in Iran. Anytime there's a conflict, we remember that these situations carry real human consequences. Before any investment theme, my heart is with the families and communities living with fear, uncertainty, and loss. It's impossible to separate market movements from reality that people are enduring profound disruption and grief every day. At the same time, we as investors need to understand what this means for the markets and for your portfolios. And so with that in mind, today I'm pleased to be joined by Thomas Mucha, Managing Director and Geopolitical Strategist at Wellington Management. Thomas is a member of Wellington's global macro strategy team, where for more than a decade, he's focused on geopolitical analysis and macroeconomic research to support portfolio decision-making. Wellington is also an asset manager that's partnered with Wespath for a very long time. They've managed a global fixed income portfolio as well as an equity strategy book for our investors. So today we'll be tapping into Thomas and Wellington's perspective as we think about today's global geopolitical risks and the war in Iran through a long-term investment lens. Welcome, Thomas, and thank you for joining us.
Thanks, Johara. It's a distinct pleasure to see you again and to be here.
We appreciate your time, knowing how busy you are. So before we really dive into the situation in the Middle East today, do you mind sharing a little bit about your background, your role at Wellington, and how your perspective shapes Wellington's partnership with Wespath?
Sure, thank you. So I am Wellington's geopolitical strategist. I've been with the firm now for 11 years, and Wellington actually recruited me out of the journalism industry. I was a journalist for about 20 years prior to coming to Wellington. And so I had been out there in the real world covering the Arab Spring, Libya, Syria, Russia's invasion of Crimea, and all sorts of other geopolitical events. In the middle of that journalism career, I got my master's degree in economics. I studied at the University of Chicago. And so I've always been a macro nerd as well. So they plopped me on the macro team. And for the past 11 years, I've been advising our portfolio managers, our analysts, our entire investment team and research team on geopolitical risk and geopolitical opportunities. And so I'm directly involved in all of the geopolitical conversations through the investment lens. And then on the research side, I'm having daily conversations with policymakers. So current and former CIA, Pentagon, State Department, National Security Council officials, White House officials. I have a bunch of defense and intelligence contacts that I've built up over the years across Europe, the Middle East, Asia. And so I think, it's important to have those contacts with the national security policy environment because I think that's the core variable. And it's especially useful to have this now. Given that we're going through a very disrupted geopolitical environment. So that's my job.
Can I ask you this question just generally based on like your relationships and contact? Do you feel like the level of transparency varies between administration?
So I think there is a distinct culture between various administrations. Some are more open than others. There's a different culture when you go to Capitol Hill. There's a different culture when you go to Europe or Asia or other environments. But I'd say in general, there is a distinct desire, regardless of policy intent, regardless of political background, of having an open dialogue with the markets. Because the policymakers really care about how their policies are impacting markets. And so it's very much a two-way conversation that I have with the policymakers, regardless of who happens to be in charge at any one moment. So that's been fairly consistent over that decade.
Thank you. Okay, so obviously, I really do want to focus our conversation more on the recent events in Iran in the Middle East. And we know that those events are moving pretty quickly and really trying to not just focus on the day to day. Would you be able to give us like a big picture, sort of understanding of what brought us to this moment that we're currently experiencing?
Sure. So, I think the broader structural context matters here. This war did not start in a vacuum. And we're living through a very disrupted, very conflicted geopolitical environment, and I think that's because we are experiencing the tail end of what has been a very long and a very stable geopolitical cycle. And this cycle has lasted about 80 years. They tend to last 80 to 100 years. But I think we're at the end of a cycle. And when that happens, typically you get wars, you get domestic conflicts, you get coups, you get other disturbances. And true to form, we have more than 60 active military conflicts around the world today. And that includes, Ukraine, Russia, Gaza, Lebanon, Venezuela, potentially in Taiwan, the Taiwan Strait, South and East China Seas, and on and on and on. So I think this broader structural backdrop matters. And we're in a period where conflict is more likely because we're in this transition to a new geopolitical cycle. So that's the first point. We should be expecting more conflicts like this. As to where we are in this current conflict, we're 4 weeks into it. I think Israeli and U.S. military actions have been effective, but they're clearly strategically incomplete. So they've had success at degrading missile launchers, command nodes, personnel, but stopping well short of regime change or really a decisive war termination. And I think from Iran's perspective, it's following a historic playbook. It's trying to avoid direct battlefield defeat. It's trying to stretch this conflict over time. It's adapting every day. And it's shifting pressure to areas where Iran can impose economic and political costs rather than strict military ones. And so I think the center of gravity here remains the Strait of Hormuz, where mines, drones, missiles, insurance constraints are allowing Iran to control disruption without full closure. And so I think that's where we are. I think it's a contest of wills at the moment and a contest between, I would say, superior U.S. Israeli military power centered on one of the world's most vital energy checkpoints versus Iran's ability to use this proven asymmetric capacity. And they're trying to lengthen this conflict to the point of unsustainable political pain. And I think this contest remains unresolved. My key military contacts believe that we're likely to see at least a couple more weeks here of military action centered on the strait before we get to a credible ceasefire talk environment. But those economic costs are rising rapidly for President Trump. So I think there's a lot of fluidity here as we enter the fourth week of the war.
Yeah. So as you sort of talk about the economic risks sort of continuing to rise, I know you speak directly to Wellington's portfolio team and sort of want to turn it a little bit to the investment perspective, and better understanding some of the implications caused by this conflict. So what are some of the considerations that you're sort of shaping and talking about with your team internally at Wellington?
Sure. So internally and correctly, in my view, the focus has been on transmission channels, and in particular, energy, inflation, shipping, insurance, broader geopolitical risk premia, rather than just the day-to-day headlines of this conflict. And I think, you want to look at, well, what are the transmission areas to the variables that matter most to markets? And I think here, duration of the war, duration of the conflict, is the most important variable for portfolios. A prolonged, messy conflict, I think, raises the odds of persistent volatility, higher dispersion across assets, and repeat shocks rather than a single headline repricing event. And to me, duration is the key market variable, and it's going to remain so. What I think is important here, and what's a little bit different about this conflict, is that energy risk is, let's call it asymmetric. So I think, oil flows may continue selectively, but LNG, shipping insurance, refined products, right, all of these remain more fragile, which again feeds into these inflation expectations, into central bank constraints. So when you're having a war that is centered on this vital energy transmission mode, I think it matters more to markets. So, from the military perspective, obviously, the US military is impressive, but it's not necessarily built to end this conflict on a time frame that markets would like. And so this is why I think observable military actions, not political rhetoric, but military actions are the signposts that I follow most closely here. That because I think those are the variables that are going to shape the ultimate outcomes here, particularly around duration. As for portfolio implications, I think this environment and more broadly the disrupted geopolitical environment tends to reward selectivity over blanket positioning. It tends to reward active over passive. So I think we're in an environment where we have a lot of different outcomes, and so we're trying to find winners and losers across the board, regardless of region, country, company, asset class. Right? I think there's a lot of opportunity in this disruption, and so you have to sort of sit back and understand what are the key drivers here, and how are these geopolitical variables interacting with the other core macro variables that matter to us on a day-to-day basis. So it's a very different sort of set of considerations that I think we have to make from the investment perspective. It's a terrible geopolitical environment, to be sure, but it's a pretty good investment environment if you know where to look.
We do typically see volatility as an opportunity as an investor. It's just unfortunate that we're talking about the current geopolitical situation, but just truly seeing it from an investment perspective, we always want to position our clients' portfolios where they get to take sort of advantage of these opportunities, but
Yes.
also really understanding the long-term implications of these types of situations. And so zooming out a little bit here, you talked about energy security and it being different across the globe, and specifically around, some retaliatory attacks, whether it's around energy infrastructure that you mentioned, general oil supply, national security of other countries. Where do you see some of the impact near or long term for just the Middle East or countries, outside of the US overall?
Yeah, so I'll say a couple things. One, I think it matters greatly to the future of the region, the Middle East region, how this conflict resolves, right? Do we end up with a much more hawkish sort of IRGC-led regime that can continue to threaten the Strait of Hormuz, which of course is critical to the global economy, but also with the ability to continue to threaten U.S. allies across the region, Saudi Arabia, UAE, Oman, Qatar, and others. So I think that's a key question is, what is the spillover risk here? And, how does this happen and how does this end with regard to the Iranian regime? And so I think there are two key variables here that we have to pay attention to, which is, at what point will the Strait of Hormuz be opened? And under what conditions? And currently, the U.S. military plan is to try to force an entry over the next couple of weeks. And that's where I think our investment focus should be. But overhanging all of this is the nearly 1,000 pounds of enriched uranium that is still in the country. And if you end up with a much more hawkish Iranian government that's still in power at the end of this, right, I think they're incentivized to fully race for a nuclear weapon. So you have these two big market overhangs that are tied to, I think, the military outcomes here. And so again, to me, the signposts here really point back to, well, what are the facts on the ground? And I think those facts on the ground will be determined over the next coming days or weeks.
So, one more sort of zooming out question for you, Thomas, and really just appreciate your perspective so much here. So, in terms of the geopolitical risk, the global trade relationships, and other areas of tension, you mentioned in the beginning about 60 conflicts going on around us globally. Do you see this sort of conflict being this temporary disruption to sort of the world order, or do you see this being a meaningful inflection point, fundamentally changing how investors should see the world?
Yeah, thanks, Johara. That's a really important question. I think this conflict reinforces a broader trend that I've been emphasizing for a long time, and that is geopolitics is now a structural macro force, and it's not an episodic shock layered on top of fundamentals. I think this is part of our new normal. This is why I talk so much about the structural backdrop. I think it's different than what most of us have grown up with. It doesn't mean that the other variables don't matter, but it means that the geopolitical variable is interacting more directly with inflation, with growth, with fiscal policy, with monetary policy, with liquidity issues. So I think that's structural, and I think that's going to be with us for a long time. But I also think the conflict heightens how the United States and China are central to this structural shift, and how the US and China remain on opposite sides of most of the geopolitical hotspots that we're seeing, right? Obviously, this one, obviously, Ukraine, Russia, Venezuela, Taiwan, South China Sea, East China Sea, the Korean Peninsula, right? The US and China have different strategic objectives for each of these. And I think that adds more stresses to the bilateral relationship and raises the stakes globally and across all of these other areas. I also think that, the Iran conflict thus far underscores the limits of military solutions in system level conflicts, right? So, I think precision strikes clearly degrade capabilities, but they don't by themselves resolve underlying political or strategic challenges or drivers. And I think that's especially true in a great power world where energy is seen as a strategic asset. Um, Broadly speaking, I think this is going to rapidly increase the fragmentation of the global order that we've been seeing. I think U.S. allies and partners are hedging more, right? They feel, less confident in U.S. foreign policy actions. So I think that's going to have some long-term investment implications. It means that this focus on national security around the world, in Europe, in Asia, of course, in the United States and China, I think that's likely to continue, right? And that also includes strategic industries that matter most to great power competition. So I think there's going to be continued policy focus on semiconductors and space and robotics and automation and drones, artificial intelligence, right? All of these emerging technologies that are now seen through this national security lens. And then I'd say lastly, from our perspective, from your perspective, I think this strengthens the case for scenario-based thinking, right? We need to be thinking more about fat tails, longer timelines. I think we need to do more repeat stress tests on portfolios rather than thinking of geopolitical events as one-offs. And again, I think this is part of our new normal. And I think it behooves all of us to have views on how geopolitics plays into these core outcomes. And again, I'm going to remain optimistic about the investment opportunities here because these shifts in the global order only come around, let's say, once per century. And so I think these are long-term trends that we can tap into, but you have to shift your understanding of what's really driving policy globally. And that really is towards national security. 10 years ago, if we were having this discussion, it would have been about integration and how do we make our
Right.
economies more tied into this global economy. That's not the world we're living in right now. So I think we need to shift our investment focus a little bit here.
I appreciate this, and I feel like we could talk forever, Thomas. And I am certain you get invited to so many dinners, and people love hearing your perspective, and you're welcome to my house anytime you want for dinner to continue this conversation. So with that, I also appreciate you bringing up scenario analysis and stress testing portfolios. We talk to our clients about that all the time in building asset allocation studies for them. We build out scenarios and want to make sure they're so informed, especially during these volatile times, how their portfolio is set up and how it behaves in different market cycles. So appreciate you hitting on that as well. And just thank you again very much for your time.
Johara, thank you so much for having me, and you know how to find me.
Welcome to the Q1 2026 Wespath Investments webinar. My name is Joe Halwax, Senior Managing Director here at Wespath, joined by my colleague and University of Illinois alum, Karen Manczko. What can we say? The world looks very different than it did when we last joined you 3 months ago, obviously owing to the Feb 28 bombing of Iran. What we're seeing is a real structural shift in geopolitics, in energy delivery, and also in asset prices. And it's shifting the way that we're looking and managing risk. So today, we're going to evaluate what happened up until Feb 28th, and then take a look at what's happened since the invasion of Iran. We're going to take a look at Wespath funds and your performance of your portfolios, a look at some of the new changes in the Wespath funds, and then we're going to wrap it up with a look at 3 scenarios for oil. But first, a quick nod to our alma mater and Final Four team, University of Illinois.
Well, I love bringing in University of Illinois into anything that we do. And so I think a really good analogy is, how it relates to the current market environment and the recent loss that University of Illinois had in the Final Four to UConn. I think when I think about the University of Illinois basketball team, they played well, they had really strong fundamentals, a great bench of players, but UConn just really kind of represented a period of overwhelming forces against University of Illinois. They have the depth of the bench, the momentum. When you think back, UConn was the national champions in 2023 and 2024, so they kind of had that momentum going into the Final Four, which just simply changes the conditions of the game. So right now, markets feel a little bit similar to that game. Illinois representing good companies, strong strategies, strong earnings reports, reasonable balance sheets, really good long-term growth prospects, but they're just up against a dominant opponent, UConn. Think about UConn as being the higher interest rates for longer, tighter financial conditions, elevated volatility and uncertainty. So really macro forces that can overwhelm fundamentals in the short term.
So when I'm paying $5 for gas, I'm going to be thinking about UConn as my nemesis.
Yes.
So, all right, so Karen, I mentioned that we were looking at the quarter, and it obviously changed dramatically in March. So let's look at the quarter as we got up until February 28th, under the context that knowing after Feb 28th and things changed, things tend to revert back to where we were before the shock.
Yeah. So if we think about the markets prior to that February 28th invasion, the start of 2026 was fairly constructive for the markets. Economic growth, as we reported in the last quarterly update, economic growth was slowing, but it was still positive. Inflation had come down from its prior peak. So I think everyone was watching, investors were watching, and become increasingly more focused on how central banks will begin to ease. Corporate earnings were holding up well. We saw some positive market returns. Oil prices were stable, and I even would argue in some areas pretty cheap. So the risk appetite was really a little bit cautious, but functional. So in short, really, the markets were in this more late cycle but orderly environment, cautious but not stressed. I think we were more concerned, like I said, with rates and valuations over really geopolitical risk. But really, if we look at this chart here, that's going to be on the screen, is a really good chart to show. So on the left, you see the price of oil. And you see that sharp spike from when it was near $60 pre-invasion to roughly $110 a barrel 5 weeks later. And on the right, you see the five calendar years, and it tracks the price of retail gasoline. The orange line goes vertical, similar to what we saw in 2022, and that represents 2026.
Yeah, it's kind of a scary chart here. And I'm thinking of fellow alumni, Rich Excel on the CFA podcast recently was talking about after Feb 28th, when you have crisis and shock, all correlations go to 1, or in this case, -1. So the podcast really talked about how since Feb 28th, you see if there's a talk of a ceasefire, you see oil go down, equity prices rally. And then when there's an escalation in say the rhetoric or the physical bombing, then you see oil prices spike and equity prices come down. So the correlations right now are running quite high, which if 20% of oil is flowing through one narrow place, that seems to make a lot of sense. But then let's think about then going back to like after Feb 28th and what we've seen since then.
Yeah, so it really became this risk-off regime or risk-off environment. So the immediate aftermath of the bombing was oil and energy prices surge, which can be expected because investors were pricing in a potential disruption to that supply. And then obviously there's heightened geopolitical risk as well. So we saw that energy shock really kind of flow through to the markets. I think the name of what we're going to really be talking about is oil, inflation, and interest rates. And you're going to see those three things kind of pop up throughout the rest of the webinar. So again, it kind of reignited those inflation concerns, prompting repricing of interest rate expectations. So as a result, we saw equity markets sell off globally. It really put most of the pressure on those mega cap names, those growth names. They were already trading at pretty elevated levels, so they're a little bit more sensitive to the news, I would say. International markets pulled back. Probably recall from the last webinar or our 2025 update is that internationals finished 2025 pretty strongly, re-entered into 2026 strong as well. So we did see some pullback, and part of that was driven. We did see the dollar surge in the month of March. Bond markets also weakened, so it wasn't nearly just an equity story. It was also a fixed income bond story as well. Obviously, that's because of concerns with inflation, which pushed yields higher, particularly on the long end. But the good news is commodities outperformed, primarily led by energy, and we'll talk a little bit more about that in a moment.
Yeah, I think I saw today before we walked in, oil is actually at 116, so we've gone from 110 at the end of the month, even higher in the last 7 days. Thinking about when we started the year, we looked at the 6 major themes that we talked about as an investment committee that we want to talk about with clients. And obviously, number 2 is in the driver's seat for now, and it's going to probably stay there for the next 4 to 8 weeks. But Karen, what about AI? We were still concerned about that, or it was the theme, and now where are we at?
I mean, AI continues to be a compelling long-term theme. Noted that there was some elevated valuations and also the concentration of AI names in the market, which really makes it sensitive to and vulnerable to really rapid shifts in sentiment to the asset class or the types of stock. And we did see that throughout the quarter was risk resurfaced, because there was a poorly received earnings report from Microsoft. So we saw a pretty big loss in that company's stock that we hadn't seen in years, just again, kind of being triggered from this poorly received earnings report from this company. So again, AI continues to evolve at a rapid pace. It's going to be a clear theme for the near term and even the long term, and definitely capturing the attention of investors at this time, and for some time it will.
Yeah, and software really got hit. When you think about software, their numbers are still great. They're cutting workers like the likes of Oracle, but they're maintaining margins. But now, if you can get into Cloud Code and Vibe Code away from some software that you're used to paying for, it's hard to know what that company's now worth in 10 years. So it's going to be a tricky time as the disruption comes from AI. Thinking back to number 2 at Geopolitics, I want to mention that our CIO, Johara Farhadieh, has a segment with Thomas Mucha, and they go pretty deep on the geopolitical side, and they start talking about the mega trend shift into a more bipolar world that we've been seeing for some time, the reshoring of supply chains, and they go pretty deep on that and the long-term effects of this. So we encourage everyone to watch that segment. And then as addition note, a couple other things on here. When you think about private markets down on bullet 6, there's a lot of talk about private credit. And what we would say about private credit is if we get into the worst case oil scenario, if we get into really longer term economic weakness. That could be the trigger for, say, some for that to see more defaults in the private credit space. And then I think, and when you think about rates and central banks too, the Fed has a dual mandate, so the Fed might not have to raise rates as high as other central banks in that worst case scenario, which obviously we hope doesn't happen. But we'll keep watching these 6 major themes that keep driving markets this year. Let's now switch gears and let's switch to a look at the market impact. So we had a negative quarter for the first time since Q1 of 2025, which was leading up to Liberation Day. This is the worst quarter we've had since 2022. And we just went through 5 straight weeks, 5 negative weeks, which is the first time we've done that in a while until last week was positive. So looking at this slide, Karen, what can you say about it?
Yeah, so this slide shows the performance for the quarter organized best to worst asset class for this time period. So what really stands out immediately, Joe, and like you mentioned earlier, is that we did see some more negative returns across the asset classes than we'd seen in previous quarters that we've reported on, which really reflect a clear market shift. I'm going to start with international equities. So as I mentioned, international equities entered 2026 on solid footing, particularly emerging markets. You can see emerging markets on the slide down a little less than a quarter of a basis point. Again, this wasn't driven by weak fundamentals or weakening fundamentals. It was purely based on the rising uncertainty that's tied to these geopolitical developments, especially in the Middle East. Also, we saw energy prices spike, begin to reprice inflation and growth risk globally, which also weighed on international equities more so. So if we kind of shift our eyes down the slide, looking at U.S. equities, the S&P 500 posted a loss of 4.33% for the quarter. Again, this wasn't an earnings collapse story. Corporate fundamentals strongly held up or positive. Instead, it was really a valuation and repricing story driven by oil prices and, again, that renewed inflation concern that we kept hearing about. The worst performing asset class was mega cap stocks. You can see down at the bottom, down 11.64%. These companies entered the year really at elevated valuations, which I would say would be more like a crowded positioning, making them really sensitive to shifts in the marketplace or any sort of news like inflation or interest rate concerns again. But at this time, and we're going to shift our eyes back up on the slide. If we think about, there was a rotation into small cap stocks. So you can see small cap companies were in positive, returning 89 basis points, which was the leader for the equity markets for the quarter. I will say that timing does matter. Markets, the performance of the markets changed meaningfully throughout the quarter, as we mentioned, kind of that February 28th date, when there was tensions were escalating with Iran. We saw that spike in oil, which was really the catalyst for increasing volatility, altering those inflation expectations, and really driving this sort of risk-off sentiment from investors, which pulled the equity markets into negative territory across the board.
Yeah, I think the rotation theme you had is certainly one we've been seeing since last fall, continuing into the quarter. Really, March was the kind of disruption to that. Thinking about the peak, when you look at the ACWI and the EM and S&P 5, I believe they peaked around Feb 14, 16, and 20. So the more sensitive areas to energy, which Europe and Asia are more sensitive, emerging markets are more sensitive, say, than the U.S. because we're a net exporter, seemed to roll over first, and they were hit the most in March, more so than the U.S. Let's move on, though, from equities. We'll talk more about our equity funds in a second, and let's look at fixed income. When I think of a major conflict like this, and you see things like the dollar rallying and flight to safety, we wouldn't normally think of treasury of yield curves moving higher. Yep. So let's talk about fixed income.
Yeah, so we can't talk about fixed income without talking about the yield curve. So you'll notice on this chart that's on the screen is that on the short end, so you see the blue line represents March of last year, March of 2025. The gray line represents March of this year, so more recently. So you're going to notice on the short end, we did see yields drop on that short end. But if we kind of glaze our eyes over to the right, you'll notice that yields rose on the long end, which really is reflected in that fixed income market return. Just as a reminder to our listeners, our viewers, is as rates rise, the price of your bonds go down. So as we saw on that far end, the rates go up, it did negatively impact the fixed income market, which you'll see on that next slide. The U.S. aggregate index was roughly flat for the quarter, but it is important to note that it lost 1.7% in the month of March alone. So a lot of this driver of the fixed income returns that we see was purely based on what we saw in the month of March.
Yeah, it really looks like in the short end, the 2-year, you saw a rise of 48 basis points in the quarter, about 40 in the 10-year. Any thoughts on that? Is it purely just inflation expectations that's driving yields higher?
Yeah, so as I mentioned, bonds struggled in the first quarter because of rising oil prices, which fueled this inflation concerns, pushing those yields higher, which is forcing a repricing of interest rates expectations. We also saw the U.S. dollar rally in the month of March, as I mentioned, which adversely affected those non-dollar bond allocations. You'll see the Bloomberg Global Ag Index at the bottom, returning negative 1.07%. So while bonds play an important role in portfolios, really the quarter served as a good reminder that fixed income is still vulnerable when inflation risks reemerge and when rates move higher. So always something we need to be cognizant of. But one final note, Joe, before I'm going to turn it back over to you, is that if we look at this chart, is that commodities were the best performing asset classes. And we kind of highlighted this in our opening remarks. Commodities were up 24%, which was obviously one of the best performing asset classes across the board between bonds and equities. Again, this was primarily driven by those sudden geopolitical risk or events that were happening with the supply shock and supply chain shock, and really those inflation dynamics with investors positioning. This is a positive for our investors that are particularly invested in our inflation protection fund, as we have a 10% allocation to commodities. But I'll touch a little bit more on that later.
Yeah, when you think about, as we're getting ready for this, you can think about 20% of the world's oil that passes through the Strait of Hormuz, but then other things like chemicals, like helium, fertilizer, things like that. And so when we think about that, the oil goes from 67 to 100 in 30 days. And energy prices, they move, it acts like a tax. It's a tax on food, transportation, on manufacturing, on supply chains. And so it makes sense that we've seen this kind of negative reaction globally. But then if I can give some hope to this to this segment, historically, when you look at oil shocks specifically, they don't tend to have a long-term impact on asset prices, which is why we asked you about how things were before this oil shock. And if you look at the year after an oil shock, the returns are roughly 8% for equities, which is the same historically as they are in every other calendar year. So what we're hoping, obviously, is that this holds true with this time as well, and hopefully that this is also shorter lived. All right, moving on to Wespath fund performance. Karen, I'll cover equities if you can cover fixed income. And looking at the top of our active U.S. equity fund, it was up about 1% versus benchmark, still down on the quarter, given what we saw particularly in March, but outperforming. We had 3 of our 5 active managers beat their benchmark. We are still slightly underweight mega caps, which certainly helped, given what you mentioned about mega caps earlier. In stock selection, contributions were in industrials, IT, and consumer discretionary. On the international side, we were slightly lower than the benchmark, right about at benchmark before fees. And so we slightly underperformed. We're underweight to value and underweight slightly to energy, and obviously energy, which you just mentioned, was the biggest performer, particularly in March. We had 2 of our active managers were above the benchmark, 2 slightly below, and 2 were right on it. I also want to highlight on the slide that we have our 3 index strategies. We have the U.S. Equity Index, International Equity Index, and Social Value Choice Equity Index. Reminder, Social Value Choice is a blend of U.S. and international stocks. And then, Karen, what do we want to say about some of our new managers?
Yeah, just kind of briefly as a reminder to our listeners and our viewers is that we did have some manager changes within the U.S. Equity Fund. We highlighted these in the last quarterly webinar, but just as a reminder, wanted to show them to you all as we did highlight the performance of our U.S. Equity Fund.
Yeah, and I think as we look at here, we're looking at a real balance of risk and more resilient stock selection and set up for a more higher dispersion market.
Exactly.
And then fixed income. How did Wespath perform in fixed income?
Yeah, so looking at our fixed income funds on this slide, right at the top, you see the fixed income strategy. A reminder, this is a 100% active fixed income product at Wespath. We did lag during the quarter. Primarily, this was any sort of diversifying strategy outside of U.S. Treasuries was a detractor to the performance. Also, the fund does have an allocation to emerging market debt. And as I mentioned, a lot of those non-dollar allocations was a detractor as we saw the U.S. dollar rally in the month of March. Also, some of those duration-sensitive sectors within the fixed income market also were a detractor as we saw rates rise on that long end, obviously having an impact to those types of strategies. But despite that underperformance that we had for the quarter, if you look at the farther time periods, historic, you'll notice that the fixed income fund has outperformed its benchmark across all time periods historically. The last one I'll highlight is the Inflation Protection Fund. This fund outperformed its benchmark modestly, primarily driven by global inflation-linked bonds. Obviously, that commodities exposure that I highlighted earlier, as commodities were one of the best performing asset classes for the quarter. Again, this fund did well, driven by inflation concerns, that energy shock dynamic as well, all kind of bolstered the performance of this portfolio.
All right, so we're going to wrap it up now. We mentioned we're going to bring three scenarios for potential for oil prices. And I do want to mention we're filming on April 7th. Today is the ultimatum day, so I hope that this is still relevant when people watch this. But there's three scenarios. Let me do the worst, the best and the worst, and maybe you do the base case. So we can start with the most constructive outcome. Constructive outcome, hopefully, is that something is resolved relatively soon. You would see oil retreat from its $115 to probably back near $80, $85. Doubtful we'll get back down to 60, given the amount of volatility that we've had and the disruption and concerns about future supply. We would have to think that puts the inflation expectations much lower and possibility for a Fed rate cut at some point in the future. And you'd have to think asset prices would rally.
Yeah, really that. And if you think about the central case kind of in the middle, is that disruptions persist April into May. Oil averages about $95 to $100 per barrel. We see that CPI in April number get reported above 3%, with all of that energy kind of pass through and sort of driving that increase in that CPI, which makes the Fed kind of hold steady through May and June, which would be that September would be really the earliest easing window that we may see from the Federal Reserve. Markets remain a little bit volatile. Commodities, energy, and TIP outperform. And then we do see, obviously, the impact of the yield curve, which makes those duration-sensitive strategies lag a little bit.
Yeah, and I think to wrap it up on the downside, we mentioned it already, but in a protracted scenario, again, seeing oil that could go even higher. As we were preparing for this, we saw that the recent spikes in 08 and in 22 have been above 120, but we've never really seen oil sustainably above 100, 124 weeks, months at a time. Obviously, we would have to think that would point us much more towards recession. Other countries probably have to look at raising rates in the face of inflation. It's a scenario that we just hope doesn't occur, but that would be the worst case.
Yeah, we'll definitely keep a close eye on the markets and make sure that we keep our investors updated on how things progress, particularly as the geopolitical events unravel. For those of you that aren't signed up to receive our weekly market update, go on our website, sign up to receive that. This is, the easiest way for us to send out information so that you all feel informed about what's going on. So I think to wrap up, it's, bring it back to Illinois and UConn basketball game. As I mentioned, the markets right now feel a little bit like Illinois running into UConn in the NCAA tournament, that Final Four game. Illinois didn't do anything wrong, but definitely the markets favored a dominant opponent. So in the markets, strong fundamentals can still struggle with macro forces that kind of overwhelm that matchup that we have, which is why really having that disciplined approach, remaining patient, matters more than being reactive, especially when it comes to your portfolio.
So we want to thank you for joining us today. We want to thank you for your partnership. Thank you for trusting Wespath to steward your assets and helping us support your mission. If you have any questions about anything we talked about today, obviously the markets are very fluid, very dynamic. Please send a note to your Wespath representative. We look forward to seeing you all at quarterly meetings in April. And thank you again for joining.
Hi, everyone, and thank you for listening to our session about today's equity landscape and also to hear about Wespath's perspective. I'm Karen Manczko, the Director of Institutional Relationships with Wespath, and I'm joined with my two colleagues, Frank Holsteen, the Managing Director of Investment Management, and Andrew Steedman, Associate for Public Equities. Thank you both for joining us. There's a lot of noise going on in the markets right now. Mainly driven by geopolitics, energy, inflation fears, just to really name a few. So kind of starting things off, Frank, at a high level, how is Wespath thinking about equities in today's market?
It has indeed been a volatile end to the first quarter. You recall when we published our outlook at the beginning of the first quarter, we identified geopolitical risk as one of the things we were looking at and the potential for volatility. And unfortunately, we have certainly seen that with the Iran war and the volatility that came with it. And you're right, many economists and investors tend to think of it as noise, not knowing if it'll be short-term or long-term. Obviously, there's an incredible human impact that we don't look past. That sometimes is hard to fathom. But you're right that certainly there are significant shorter-term impacts. We're not sure how this will unfold. The closure of the Strait of Hormuz, the blockage of energy, and the inflationary impacts, certainly could push the global economy into a recession. But I also think there's the potential for longer-term, bigger picture impacts around the U.S. relationship with allies, relationships among the Gulf nations in the Middle East after the way Iran struck at neighbors. And so when there's significant change, when there is significant new information, our response is to go back to our investment philosophy, which really serves as the foundation, the bedrock for how we do things. And so I think about things like focusing on research and purposeful diversification. And so that's exactly what we're doing now. We're conducting that research and stress testing and whatnot.
Yeah, that was kind of my next question is, how does U.S. equities fit into our broader philosophy that we have at Wespath?
Certainly the philosophy of research and diversification isn't just across regions, it's also within U.S. equities themselves. And so during the first quarter, we actually saw quite a rotation in performance within U.S. markets, where the large tech companies really underperformed in the first quarter, and not surprisingly, energy and materials companies outperformed. Certainly, we saw appreciation in the U.S. dollar, which is a bit of a change over the past year. So, in March, the U.S. Was a little bit more resilient than international equities, but also in that outlook that we'd published at the beginning of the quarter, we identified deficits within the U.S. as an issue to watch, and a war is extremely expensive. Yep. I've heard over $1 billion a day. We talked about the Fed rate path, which under this revised inflation outlook is changing. Probably, the market thinks probably no rate cuts this year. And so there too, go back to our philosophy, conduct research, and be very purposeful.
Andrew, I know a lot of conversations we have with our institutional investors and even our institutional prospective investors is really around active versus passive across global equities. What does the latest research say about that?
Yeah, thanks for the question, Karen. Going back, as Frank mentioned several times, our investment philosophy, we specifically state that we want to thoughtfully blend active and passive management where it makes the most sense. So as an investment team, we have spent a lot of time researching this topic, discussing internally and debating among the group. generally, we believe that active management is more effective when markets are less efficient, meaning that information is not quickly reflected in security prices. Markets are typically less efficient when there are less analyst coverage, less investors, and worse liquidity. So in U.S. equities, we believe that large caps are more effective for passive management, and we target active management in U.S. small and mid caps. And you see that in U.S. equity fund, where there's a larger allocation to passive management, a smaller, more targeted allocation to active management in U.S. small and mid caps. And we see that when we analyze historical manager returns as well among our managers and the broader universe, where it's easier for a manager to outperform the benchmark in less efficient markets like small and mid cap. Turning to international equities, research shows that those markets are less efficient, and there are more inefficiencies for active managers to take advantage of, and active management typically does better in international equities. We see that reflected in international equity fund, where there's a smaller allocation to passive and a larger allocation to active management, where we're specifically targeting passive through international equity index fund to large and mid-cap developed markets, which are slightly more efficient, and we have targeted active exposure in international small caps and emerging markets.
Yeah, that's interesting. I mean, and especially, to be kind of curious, and Frank, I'll direct this question to you, is obviously right now you highlighted there's some uncertainty. We maybe see some dispersion in the market because of this uncertainty, and we've even seen some of that kind of transpire in the last few months, especially in the month of March. Where does active management play? We know about inefficiencies and efficiencies, but when we have this heightened uncertainty, how do we view philosophically active management in a portfolio during this times like we're in right now?
In my mind, and in speaking with active managers and my experience, is when there's greater dispersion is when there's greater opportunity for the active management. The portfolio managers are scrutinizing company by company, stock by stock, and in periods where the market is just throwing money at the market, there's not a lot of investor scrutiny amongst names in the portfolio. And likewise, when they're making large withdrawals, kind of a broad brush paint stroke. And so when we get into these times when there's greater dispersion, there's really greater opportunity for the active managers, and eventually the rest of the market comes around to apply the same kind of discipline in evaluating the companies.
Yeah, so maybe there's like a name that they've been watching, but they viewed it as expensive. So when we see these dispersions, it likely creates opportunity for
Certainly
them.
can.
To do that. Yeah. So kind of on this equity asset manager, and Andrew, I'll kind of direct my question towards you. How do we think about, obviously we have managers in our portfolio that are more like broad-based, and then we have obviously more concentrated managers that may only hold, a hand, maybe like 10 or 20 names in their portfolio. How do we think about concentrated managers versus non-concentrated managers as it relates to portfolio construction in our equity funds?
Of course, Karen. We've spent a lot of time researching this question as well, going back to the philosophy where we want to make all of our decisions based on investment research. And we found that more concentrated managers that are more different from the benchmark are more likely to have a return that is more different from the benchmark, both positive or negative. However, we believe with our robust manager research and due diligence process that we're able to find those managers that are more likely to outperform the benchmark. That being said, we've recently leaned into these more concentrated managers in our equity funds, specifically within U.S. equity fund. We've invested in two managers, Axiom and Voss, which hold typically around 30 names, larger position sizes, and we would consider these opportunistic managers. On the other side of that, we maintain that we want to be properly diversified, and we don't want one manager or one return stream or one factor to really drive the performance of our funds. So with these concentrated managers, we're making sure that we complement them with managers that do different things so that we have a smoother return stream over a market cycle.
Yeah, and also, when I think about this, I also think about risk, right? Because you only want to focus on risk and concentration, but and return. So I often hear Frank, the Johara and other leaders at Wespath talk about preference for idiosyncratic risk over factor risk. What does this mean conceptually, and why does it matter, and why should it matter to our viewers?
Sure. Well, conceptually, factors are characteristics that we can mathematically measure and model that different groups of stocks might have in common. A factor could be size, meaning the capitalization of the stock, or it could be value, the price to earnings ratio, and you can mathematically measure a stock's exposure to various factors. Mm-hmm. And if you end up with a portfolio with a heavy tilt toward a particular factor, that could be intentional or it could be unintentional. If you have active managers that are picking stocks and inadvertently give you a portfolio with an unintended factor exposure. So we are very careful to monitor factor exposures. If you think about idiosyncratic risk, that's really stock by stock. It's not some characteristic that's broad across the universe. And so when you have asset managers who choose stocks where we can identify the risk as primarily idiosyncratic, that provides better diversification. Mm-hmm. Factors can rotate quite cyclically, mm-hmm. and so idiosyncratic risk provides better diversification.
And Andrew, kind of going back to you, how does this play into fund construction, manager selection, these different types of risks that Frank just highlighted?
Of course. I can start with manager selection first. As we're evaluating either prospective or current managers, we want to make sure that our managers are taking on more idiosyncratic risk than factor risk. We want to make sure that the excess return that they're generating is coming from stock picking rather than factor exposure. In the markets, you can get factor exposure extremely cheap, and we want to make sure that we're not paying active management fees for factor exposure. So that's how we're looking at it from a manager standpoint. From a fund construction standpoint, we want our funds to lean towards that stock-specific or idiosyncratic risk and away from the factor risk. We want to make sure that no one factor or large bet is going to drive the risk and return of our funds. And in doing so, we're actually reducing the risk profile of our funds and allowing our best-in-class active managers to generate returns through their stock picking.
Yeah, thanks for the update. And our viewers have heard a lot about changes to the equity funds. We had some changes to our U.S. equity fund. What updates should our investors expect as it relates to our equity offerings?
Of course. We've done a lot of work in 2025 on U.S. equity fund that we've discussed a little bit today and in previous webinars. Additionally, we want to make sure that we're creating greater flexibility and choice for our client base. And in doing so, we plan to offer additional options, additional equity offerings in 2026 for our investors, starting first on the domestic side and then moving towards the international side. I think the second update that's worth sharing is we've been doing a lot of work on international equity fund. In 2025, we launched International Equity Index Fund, which serves as the passive component for IEF. We changed the benchmark to the ACWI ex-US at the end of 2025. And the team and myself are currently meeting with managers, fleshing out our conviction in active managers, and thinking about how we want to allocate the broader fund.
Great. Well, thanks for the update, and thanks, Frank, for your update as well. And always love sharing your knowledge and your expertise with our viewers. And thank you all for tuning in.
Hello. We're going to dive a little bit deeper this segment into investment strategy in U.S. equities, and specifically systematic U.S. equity investing. And in this first quarter of the year, we actually introduced a systematic equity strategy within our U.S. equity fund. And in the coming months, we're planning to make that available as a standalone option for institutional investors. And so, Andrew, how about if you tell us what that even means? What is systematic investing?
I would be happy to do that. Systematic equity investing seeks to add a modest amount of alpha over the benchmark annually with strict risk controls. This is an active strategy that is intentionally like the index to reduce factor bets or factor exposure and focus on generating alpha through stock picking or stock-specific risk. The underlying manager, BlackRock, utilizes a quantitative approach that relies heavily on large amounts of data, both traditional and non-traditional data, large language models, technology, artificial intelligence, and research to construct a portfolio and forecast signals for each stock within the universe. The systematic equity strategy relies on fundamental intuition or signals that make economic sense. However, it is different than a fundamental active managers. Our investors can expect this strategy to be more broadly diversified than a traditional active manager with stricter risk controls. Additionally, the quantitative data-driven approach is going to be unique to the systematic strategy. On the other side, it's different than passive management, which seeks to just match the benchmark returns, because we expect this strategy to generate excess returns or alpha over a market cycle. Frank, as I'm talking about systematic, fundamental active, and passive, can you maybe tell our investors a little bit about how these three types of strategies complement each other in a broader U.S. equity portfolio?
Well, I think you described it well, that systematic really falls in between purely passive strategy and a more concentrative, purely active fundamental strategy. And so it has the benchmark awareness and the risk controls that make it relatively predictable as a performer, much like relative to a benchmark, but also that potential for alpha. And so I think it's a great complement lying between passive and active. I also think it can be a standalone option for some investors who really want to understand their risk exposure relative to a benchmark index like the Russell 1000, but also have the opportunity for some outperformance, very controlled outperformance. And so
Exactly.
I guess we're going to have the opportunity to listen in to your interview with the head of Systematic at our investment manager, BlackRock. So I'm looking forward to this.
Exactly. Hi, everyone. We wanted to invite Travis Cooke, a portfolio manager for BlackRock's U.S. systematic equity strategies, to our webinar to discuss BlackRock's systematic active equity approach in more detail. Travis, welcome to the webinar, and thank you for joining today. Can you introduce yourself first before we get into our questions?
Yeah, hi everyone. I'm Travis Cooke, portfolio manager for U.S. strategies within the SAE team, the systematic active equity team at BlackRock.
Thanks, Travis. To start, how would you define systematic equity investing?
Yeah, so I'd say there's really three key elements to it. So it's hypothesis driven, number one. It's empirically validated, number two, and then it's applied consistently over time. So if I think about what's hypothesis driven, so it's essentially we're trying to identify the attributes of companies that we think are mispricing opportunities in markets. The classic example is looking at things like valuation. So let's say you think that cheap stocks are going to outperform expensive stocks. A hypothesis that's closer to home for us is looking at something like, is the founder involved in running the company? So there the thesis is a belief that founder-led companies are more efficiently run, maybe they're smarter at risk-taking and therefore would produce longer-term better results. So the second part that I mentioned is empirical validation. So here, what we need to do is we need to calculate a formula that best expresses the hypothesis and then test it using historical data. So in that same founder-based example, it's looking at, is it true? Do founder-led companies lead to higher future profits? Do those firms have higher margins? And ultimately, do they earn outsized returns from a performance standpoint? And then the last bit about the consistency and applying that consistently through time, it's coming up with that algorithm and then doing the exact same thing on a live basis that you did in the research. So making sure that it's the same process that you're running end to end so that you can generate those returns.
Thank you, Travis. That was a great definition. Within there, you mentioned two things. You mentioned both data and research. Can you talk a little more about how data and research drive decisions within the portfolio? And additionally, how are you using artificial intelligence in your process?
Yes. So all of those things are critical to our investment process. The data is sort of the lifeblood of our process. Everything is driven by data. And the way that I would think about it is that, data kind of falls into a couple different categories. So we use traditional data and we use what I'll call non-traditional data. So traditional data is looking at things like financial statements. So think of data that can fit in an Excel spreadsheet. So things like balance sheet items, income statement items, financial statement ratio type of analyses. Included in this is also market-based data. So this can be data coming from exchanges. This can be data coming from other markets. So markets like the bond market and the options market. But that's on the traditional side. On the non-traditional side, we'll look at alternative data. That's a big component of our strategy. So that includes things like credit card spending, web traffic, online job ads, and so forth. And then another big component that's become increasingly over the years more important is looking at text-based information. So text-based information, there's many great sources, including straight from the financial statements, but we also look at things like transcripts of conference calls, broker research reports. We're getting on the order of thousands of reports globally a day. And then also looking at things like news articles and the news flow that's coming in and is impacting and getting written about firms. So we're analyzing all that, and that's really where AI comes into play. AI in our process is used in many different ways. There's almost too many ways for me to describe at this point, but kind of simplifying and breaking it down, I'd say it impacts our strategy on the return side and then on the risk management side as well. So return forecasting, we use AI. I'd say a primary use is in sentiment analysis. So AI and things like LLMs are really, really good at understanding and interpreting sentiment from text, the context under which people are making statements and saying words in things like transcripts. Another key important part on the return side is looking at feature engineering. So basically coming up with interesting components and types of elements that we can build together to come up with an aggregate forecast. So think of a new data set that we might be using when we're looking at building out different features, and AI can help us decide what are interesting features that we can use to extract more information. Another key element is looking at agents. So building agents to create things like evaluating different aspects of a company's business model. Is there a moat? Are there network effects associated with this business? What are the growth opportunities like? And then from there, a lot of AI is getting used around automating existing processes and then as coding assistance. And that's becoming more and more of a use case as coding in particular and software engineering has gotten particularly good on the AI side. The other aspect that I was going to mention is on the risk management side. And here AI has been super helpful in doing things like creating scenario analyses and then helping us build baskets so that we can measure and understand what are the exposures that we have in the portfolio as a result of those scenarios. A lot there. Maybe I'll pause and let you join in, Andrew.
Yeah, thank you. It's interesting to hear how you're using AI within the process. As you know, it's been something that has changed the way that people work over the last several years, and we appreciate how you all use it to make investment decisions and gain insights on companies. The second question I had there is, how are you all using technology to actually influence portfolio decisions and how you're constructing the portfolio?
Yeah, so I'd say technology is really foundational to everything that we do. It's critical, I'd say, in number one, just large scale data processing. Ultimately, what we're trying to do is we're trying to convert data and information into forecasts. And technology is, of course, critical, could not be done without lots of use of technology in the process. I'd say the other key component is around simulations, like being able to run optimizations and run simulations. Essentially, because of the combinatorial nature of inputs into simulations and different things that you can include or exclude, the search space is near infinite. So having a really, really fast and efficient optimization and simulation engine is critical, as a critical aspect of our technology stack within the group. And then the other component is on the implementation side, and that would include things like risk modeling, doing the work to understand risks and the strategies, and then everything from order generation to trading and execution. All of that is fully kind of end-to-end used, using and taking advantage of the technology that we have within the firm here.
Thanks, Travis. And then I had one last question to hopefully summarize and put everything together. When the team's looking at the entire portfolio, how do you think about managing unintended exposures or risks within these strategies? And then additionally, what are the risk and return expectations of the alpha tilt strategies?
So in terms of unintended exposure, I'd say, so first it's about quantifying the risk. So understanding what is the portfolio exposed to? If there is, let's say a new theme in the market or a new development, an exogenous factor of some sort, the first step for us is to first quantify that. So that could be done by starting with a group of seed companies that we know best represent that, and then expanding that out by creating full breadth baskets of companies that would benefit from that theme or companies that would get hurt from that theme. The next part is measuring our exposure. So what is the direction and the magnitude of that exposure in the portfolio? And what are the key companies that are driving it? The third part is probably the most important, and I'd say it's listening to what's going on in the market and what is the market telling us. It's that feedback loop. If we think that maybe we are positively exposed or negatively exposed to a particular theme, what is the market telling us when news and events come out in favor or against that theme? Do we benefit or are we hurt by that? And how is that aligned with the exposures that we thought that we have? Because ultimately, the market is going to dictate and be most informative in telling us as to how we're exposed to a particular theme or topic.
Thank you, Travis. To close here, we really appreciate you taking the time to discuss the systematic active equity strategies with us. We're excited for the partnership and the way that it's going to impact our underlying investors. So thank you for joining us today, and this was extremely interesting.
Thank you, Andrew.